Welcome to this video on 5 investing mistakes to avoid in a market correction. This guide is for finance professionals, students, and individuals planning their financial future. First, let's understand market volatility. A correction is a dip of 10% or more. It is a natural and healthy part of the economic cycle, not a reason to panic. Mistake 1 is the panic button, driven by emotional decision-making. Investors often sell at the bottom to stop the pain, converting temporary losses to actual losses and disrupting compounding power. Mistake 2 is the timing trap. This includes waiting for the bottom, leading to analysis paralysis, or a missed entry when the market begins to rebound. Mistake number 3 is stopping your systematic investment plans, or SIPs. Interrupting your SIPs during a market correction interrupts the power of compounding. Lower net asset values, or NAV, mean more units purchased for the same amount, which is essential for rupee cost averaging. Buying at lower prices leads to better long. Mistake 5 is focusing on noise, which includes daily fluctuations and sensational news. Successful investors focus on the signal, long-term corporate earnings, and economic growth, maintaining a 5 to 10-year horizon. From the professional perspective, the role of advisors is behavioral coaching. Empathize with client anxiety, reiterate the original investment thesis, and highlight the safety margin in diversified funds. A market correction involves a 10% to 20% decline, averages once per year, and typically recovers fast. A bear market is a decline of more than 20%, happens every 3.5 years, and recovers slower. Markets historically trend upward. Corrections are merely brief pit stops on the journey to wealth creation, followed by recovery and growth. The investor's action plan involves maintaining liquidity, rebalancing portfolios, tax loss harvesting where applicable, and topping up investments in quality equity assets if cash flow permits. Mistake 4 is discarding balance. Market corrections can shift your asset allocation, potentially leaving you underexposed for recovery. Ignoring rebalancing goes against the fundamental rule of buying low and selling high. Thank you for your time and professional interest. Remember to stay invested, stay disciplined,